Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just interviewed one of probably not one of my favorite authors, Barry James Dyke. Anthony, takeaway or two. What'd you have?
Well, I tell you, what was interesting? There's really two things Cameron and I do not agree on.
What's that?
And well, you got to listen to the show when we talk about them. And I tried to get Barry to resolve one of the dilemmas, and he was a little wishy-washy, to be honest. So we still have these two things that Cameron and I, we agree on so much.
Yeah.
But these two things we don't. So hopefully you guys put something in the notes here or comments on who is right in that instance, but you have to listen to the episode to see what it is we're talking about. Joy to have Barry on again. And I think it was so good. I think we're going to split it into two pieces. A few takeaways I had was one, and this is a newsflash. Okay. The stock market was not designed to be your retirement plan.
What?
Which I thought was very, you know what? That's something like, yeah, I know that, but I never really thought about it in that context. And he pointed out the United States has a savings problem. In preparedness for retirement, we're number 22. However, we have the world's largest economy. We have so much resources here, and we're not prepared for retirement. And that's really the crux of his book, is that we have this savings problem. We're just too much speculating, not enough investing, and definitely not enough savings.
Yeah.
Cam, what were some takeaways or two that you had?
Speaking of his book, here it is, The Retirement Ruse. Ruse? I don't know how I say that, but The Retirement Ruse. What he talks about in this book is, again, something that Anthony just mentioned, is people know that this stuff is going on, but they don't know how it's being executed. What Barry James does in this book is he talks about 4 different ways in which the average investor's money is being stolen and gambled away with zero consequences. People know that, when they put money into the stock market, it's a little unsettling. There's a lot of uncertainty, but man, after reading this book, you will know for a fact that you should not be investing in the stock market thinking it's a safe place to keep capital. And so one of the biggest takeaways that I've got from both of these interviews, one is we go through 4 of the big topics that he talks about. And at the end of every single one, I ask him, say, hey, at the end of this, who's winning? Like, who's getting all this money at the end of the day? And guess what, guys? It's not you. Right. It's always the insiders, it's the asset managers, and it's the bankers that are just pillaging public's money and taking it and lining their pockets. And so, man, this is a book that'll infuriate you, along with several of his other books. But guys, I hope you guys enjoyed this interview. Stick around. There's a lot of good information that's discussed, and it absolutely pertains to you guys. So hope you guys enjoyed this interview.
Enjoy the episode.
Enjoy it more. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we have our esteemed guest, Barry James Dyke. I think this is his 3rd appearance on our show. Back by popular demand. Barry, welcome back.
Well, thanks. Always good to see you, Cameron and Anthony. And I like your setup and the colors, by the way. I just want to let you know that. I thought it was really cool way you did that.
Okay, it looks good. And to be honest, I have to give credit to this guy. He actually built this out, and I watched him do it. He did a great job.
You did a great, Cameron, great job.
Thanks, Barry. I appreciate that.
I tell you, Barry, I want to get right into this because there is, I would say, Cameron and I have known each other for about 15 years, right?
Way too long.
Yeah, way too long. And we agree about on almost everything. Okay, but there's 2 things that we don't. Okay, well, first, you're the author of another book, and it's called The Retirement Ruse.
Yes.
Stock buybacks, cryptocurrency, unicorns, and special acquisition corporations help destroy America's savings and retirement plans. And when Cameron saw this title, he ran in all giddy. Okay, because there's two things we don't agree on. One is the importance of hair care and the overall your happiness, and are unicorns real? Okay, and he came in here. He goes, "Look, we know Barry Dyke. Do you trust Barry Dyke?" And I'm like, "Of course." He goes, "Here's proof unicorns are real." So, Barry, if you want to chime in on both topics,
Yeah.
that's fine. But at least are unicorns real?
Well, yeah, it was actually there was a woman, Eileen Lee, from Cowboy Ventures, venture capital firm.
Yeah.
She created this nickname of a unicorn, essentially of a mythical creation of a startup company. Mostly, again, most of these startups are really based in California, Northern California, out here in New England, and so on. About these tech companies with or other financial companies which have a valuation of $1 billion or more. Now, it doesn't mean they're worth that, but that's what the venture capitalists all tell us. And like they're the great soothsayers of valuation. But as you can see, if you read this book, so much of this is just crap. And but in any event, but that's so because of all the printing of money guys, which we've seen for the past really 14 years now, with Powell dropping the interest rates by 50 bips yesterday, we're going to see more of this. So essentially, and what we've seen is with all this printing of money, all this rampant speculation into new companies. But as you can see in this book, so many of them are absolute failures.
Well,
And,
Barry, I want to qualify two things of what you said. For one, you had said this book. You pointed this book and said what's in this was crap. I'm assuming you weren't referring to your book itself, but just what the story you're telling in the book is crap.
yeah, because this is because it's always done, guys, and this is nothing new. This is why I start off the beginning of the book with the quote from Louis Brandeis: "Other people's money." This is always done with other people's money, and what I documented, and this is and it was verifiable, and I use other sources to verify everything, is that most of this money is done with mutual fund money, with venture capital money, and private equity money. But none of these guys ever use their own money. They always use it from endowments or pension plans and so forth. And they put immense amounts of money into these projects, and often they tank. And if they go bankrupt, well, it's no big deal to them. But it's the reason why I'm doing this is because this is how so much of this of these if these companies go public, if they go public through a traditional IPO, or they go through a SPAC, which I get. That's the reason why I talk about the SPAC, which is essentially a merger of a shell company into an existing company. So many of these get dumped onto mutual funds, and BlackRock and Fidelity and State Street and Geodeed, which is the index arm of Fidelity. They end up in these companies end up in other people's retirement accounts, and so many have gone bankrupt, and it's despicable. But but that's the reason why I have so much data in there. That's why, Cameron, you say maybe a dry read for you guys, but that's why I had detail this stuff, because people don't really understand it.
But what I'll say in response, is man, Barry, I've been singing your praises ever since I read Pirates of Manhattan way back when. And
17 years ago, if you can believe it.
Yeah. And what I tell everybody is, man, is this book is just, these books are packed full of information, right? And the information that's in there, I don't know if you can find it anywhere else. So in the series of books that you've written, the question I have for you, just to maybe bring it back kind of big picture, is what was the genesis of this book? Why'd you feel like you needed to write this one?
It was a fluke. I have a friend, Jeff Brummett, out of Indiana, and we were going to do a marketing thing. And I had my daughter who was working for me at the time, and I knew I've been working on this book on private equity, guys, for about 11 years. Probably I started researching around 2008, 2009, and it's a huge book. I've been working on it, but so it's as this business is, you have to get your name out there by marketing in some way. And I was a good researcher, and so he said, well, what can we do? And I said, well, this whole cryptocurrency scam, which is going on right now, is a scam. And I said, then the whole the SPAC phenomenon, which is huge. It's freaking huge, and it was 50% of all IPOs in 2021. Okay, and I testify in court on this. So we had these huge bubbles and the fake the meat companies into flying air taxis and all this other shenanigans. And this was really going on during the pandemic. So like during the pandemic, all this stuff was going crazy. So I'm tracking this all stuff. I said, there's a book here. So I just started tracking it and just organizing it, and so I put this stuff together, but I just saw how much it really affects people's savings and how they retire and how they purchase things, and I saw this is getting this is getting really 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 corrupt, and so and people need to do see people like yourself to good things, holistic, and so anyway, I pulled it out because it was huge. And then you with the kind of the pinnacle of what was I don't know if you remember this company called WeWork. Do you remember that
Yeah.
one?
Yeah.
Oh yeah.
Okay. I mean, that was just kind of like all these Wellington and JP Morgan and SoftBank. They put 21 billion into this company, 21 billion, and they had 777 properties in Europe and overseas. Okay, office product. They valued it at 47 billion, and it went bankrupt in last year. I mean, I mean, and this is and when what was also eye catcher about this one is that it was putting retail savers money into this from Fidelity and Vanguard and so on. So that's why I want to really do is say, look it. I'm a capitalist, guys. I love this country. I always will. I love my technology. I spend a lot of money in technology in my own infrastructure, and but this stuff it's shenanigans, and so this I really wanted to explain to people what's really going on, and I had to document it. So I was just very patient, and I just and that's why I put it together. I said, well, let's get it out there before people forget about it.
Great. I love it. One in kind of early on in the book, you kind of say this. You say there's 4 trends of crony capitalism state wherein other people's money is being used to gamble with reckless abandon and non-existent consequences. The 4 trends are stock buybacks, cryptocurrencies, unicorns, and SPACs. That's what I'm hoping to kind of give our listeners an overview with today. Barry, if you could maybe give our listeners just an overview of what a stock buyback is and
And
why it's
stock buyback, essentially, stock buybacks were illegal till about 1983 because they were considered a manipulation of a stock. Because anytime you buy, Anthony, it is kind of a CBA question. Anytime you buy an existing amount of shares,
Yeah.
you reduce the value, and so essentially it boosts the share prices. Okay, I mean it's like you do that with anything. Anytime you increase the supply of something, it's going to theoretically increase the demand. Would you or
Mhm.
the price, the value of the entity? Would you agree?
Mhm.
All right, so instead of one of the reasons why America's economy kind of sucks, if you will, in terms of world competitiveness, is because we do so very little in R&D. I mean, I think around 2001, I think 32% of money was reinvested back into the companies. Now it's down about 6 or 7%. It's very very low. So where the money is going, instead of taking the money out of the corporate treasury and investing into the new products or infrastructure, better employee benefits or things like that, they're repurchasing shares in the open market. And the thing is that if you can believe it, guys, roughly 50% of all trading in the market is stock buybacks. Okay.
50%?
That's wild.
Yeah, roughly about that. So it's companies buying back their own shares. So it's really so by doing that, so like let's give a hard example, and I talk about Apple in the book. Now, I think Apple is they're like the serial offender. I think they've purchased roughly close to $750 billion at this point. I know it's 600-700 billion. Okay, so when that happens, the value of the share price skyrockets theoretically. Okay, and so and then when these guys cash out their shares, it's at a much higher price. They having no basis on it. They pay most of the stuff in capital gains, Anthony, thereabouts, and so so it's really good for the insiders. It kind of destroys the workforce, but it's good for the insiders and let's say the asset managers who own the company, okay, which are mostly mutual funds. But the thing is that a lot of the stuff backfires. It's a joke.
How so?
JP Morgan spent, I think, 117 billion in stock buybacks, and the stock's gone nowhere. GE, okay, General Electric, okay, government electric, whatever you want to call it, and around 2017, 2016, they spent 25 billion. It's in the book here for the exact figures, but they spent. Now here's the company they have all these pension obligations and everything else. They spent over 20 billion buying back shares of around $23, $24 a share, something like that, and the share price went backwards. Okay. Credit Suisse, the infamous Swiss bank, which goes from one scandal to the next, which is now out of business. They spent over $12 billion buying back their shares, and they went out of business. It's the same thing with Intel, the chip maker, and a bunch of other companies. And so what I saw is that a lot of this stuff is really hurting people. So this is why I'm saying you really need to invest in yourself and capitalize yourself, what you guys are helping people do. Because what I'm saying is that a lot of this money is being wasted. And so that's kind of what stock buybacks were. So a lot of them, theoretically they work. It gives a good share returns, but they don't always work. And a lot of them, and Lehman Brothers bought back like 2.7 billion of the shares before they went bankrupt. So this is the insanity of it is, but it's.
Barry, what is the downside you'd mentioned for like the line worker or the employee if a company is using their funds to buy back the stock?
Well, it's horrific because the instead of reading, I don't have all the answers, guys. The more I know, the more I don't know. But if you have a small business, and I've had a number of them, I've always found the best investments to reinvest in my own business. All right. And it's been generally true for anyone to get good in anything. Do you have to reinvest in yourself? And my point is that the diversion of capital into the repurchase of shares is really hurting the entire economy. It's just not me. Now the thing is that they're actually illegal, in the UK and they're frowned upon in the US, but I mean, frowned upon in Canada, excuse me, but they actually flourish in the U.S.
Well, Barry, if you're doing you had mentioned with GE, you had mentioned that they had a pension obligation.
Yeah. So yeah. So instead of spending money to fund their pension obligation, they purchased back their own stock, and even when they spent over $20 billion, we're not talking small money here.
Yeah.
They bought back shares when they had a $6 billion pension contribution. So what they did the next year, and I get into the detail in the book, instead of buying funding the pension, they borrowed more money to fund the pension obligation. So it's like putting money on a credit card to pay your mortgage payment, but that's what they did. So it's really improper deployment of capital.
And I would assume part of the rationale of buying the stock or buy back the stock means there's less stock out there. So in theory, the other stocks value of the stock per share should go up because there's less out there. But aren't the executives that are making these decisions, is some of their compensation based on the stock price?
That's exactly why they're doing it. That's exactly why they're doing it, because these guys all of a sudden, think about it. If you have let's say you have options, and you have share prices. Let's say they're in your shares at $15. Let's just say for it, hypothetical, and they go, instead of putting $1 billion into inventory or capital improvements, they spend $1 billion in the open market on the share, purchasing their own shares. All of a sudden, that share price may go. So by reducing shares outstanding, now the intrinsic value of the company has not changed. We're just reducing the number of shares.
Mhm.
So all of a sudden, those $15 shares prior to the buyback could now be worth 21, 23, $22 a share. So this guy's happy that the executive who get, and most roughly 90% of all executive compensation is in stock compensation. So it really benefits insiders. And I'm just really trying to help people become more independent, guys. Not to, I maybe if I was a CEO, I'd be doing the same thing. But
Yeah.
it's for regular people. It's who it's something they need to be aware of. And the thing is that the fund companies who manage this stuff are doing there's no oversight.
Yeah.
That's why there is no accountability.
And to your sentiment there at the end, I think a lot of people know that this is going on, but right until somebody like yourself comes along and documents it, there's really no proof of kind of this happening. And so, what I'm hearing you say is that right there's executives that are going through this stock buyback that are kind of taking these big fat compensation packages, and then everybody's kind of left to hold the bag. Uh, Along the same lines, right, is kind of cryptocurrency. That's one of the
Yes.
other situations you talk about in your book. Share a little bit about that with our listeners.
Well, there is, some type of electronic currency now, and I used to have a radio show myself, and I've interviewed people on cryptos, and I've read this stuff as much as I could. I said I can't figure this stuff out. Now I have a good tech guy actually, who I really respect a lot. He thinks it's still going to be there, but I've talked to a lot of people on this stuff, and no one really has given me a straight answer on any of it. And so I started looking, and I said this is another scam. So the whole even so the thing is so Wall Street and the asset management industry always needs another product to peddle, all right? Because there's been a lot of damage with the active management business, where they used to make a ton of money. That's kind of going away with indexing, and so they always want to have something new to sell. So, and the whole idea of the fiat currency is bad because there's nothing to back up. We could get fiat currencies another, but we know there's a inherent problem with paper money. But so the whole idea with cryptos is that it's going to be a stable value, or something which would be enduring value. But when I looked at it, I just said it's really kind of just another form of what do you call it? Counterfeiting. I mean, they're creating money. I mean, with algorithms and stuff like that, and I'm not disagreeing with blockchain, but I'm saying, hey, a lot of this is creating money out of thin air, just like the Federal Reserve. So I said a lot of this is a scam, and so again, the buybacks thing. During the pandemic when this thing was going like crazy, and I had done some financial plans for one guy in New York, and he was really big into it, and he got clobbered in losses. But so I just said this is another scam. So I started looking. I said this is a ticking time bomb, and so then we had the collapse of FTX and Sam Bankman-Fried and Alameda Research, which was 1.8 billion of venture capital was put into that company, 8 billion of other people's money. Okay, I'm not making these figures up. So roughly over 10 billion of other people's money. I think Bankman-Fried's got 25 years. It's an incredible scam. Um, I mean, we have these investors, theoretically sophisticated investors like
Yeah.
Thoma Bravo and Blackstone and BlackRock and Tiger Global Management and all these elite investors putting all this money. I don't even think they asked for a balance sheet, and they put all the money into it, and they went bankrupt. And and actually, and then there's been a number of other ones as well. I mean, and as you can see, even in the book, there's other ones, Celsius Network, and so much of this is um, it's not real. It's kind of funny money. It's like, I don't know, lightning in a bottle, and
Mhm.
you know, And the tragic thing is that, and actually you'll see in the book there, Pew Research did a survey on cryptocurrencies in 2023, and 75% of the population doesn't understand it and doesn't trust it. But in January of this year, they let crypto be in ETFs with Blackstone and Fidelity, and so Wall Street's got another product to sell, and it's because it's got spreads in it,
And that Pew Research 25, I would infer that 25% said that they understand it. I would say that 24% of them are lying.
Yeah.
So, I've yet to meet somebody that really understands kind of that space.
Do you understand? I don't. I mean,
none whatsoever. I think one of the issues, again, to kind of bring it back to the theme, is that the way that some of these investments are positioned or proposed to a lot of people is that it's a quote unquote investment, but at the end of the day, it's pure speculation. And
yeah.
Hey guys, stick around. We are breaking this interview up into 2 parts. And so next week, we'll be dropping part 2 of our interview with the esteemed author, Barry James Dyke.
See you next week. If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.